You know what actually separates a good portfolio from a truly great one? It's a question I hear all the time. Most people think the hard part is just setting up a brokerage account, picking a few index funds, and calling it a day. But let me tell you, setting that up, that is literally just step one. Managing that portfolio through the inevitable market turbulence, the economic downturns, and honestly our own psychological biases, now that is the real challenge.
Welcome to The Explainer. Today, we're totally demystifying advanced portfolio management. We're going to look at the specific, actionable tools that can help maximize your risk-adjusted returns without letting emotion take the wheel. Basically, we're going to build your ultimate optimization toolkit.
So here's our roadmap for today. We'll start with the optimization toolkit, then compare strategic versus tactical allocation. After that, we'll dive into rebalancing and controlling portfolio drift, followed by smart beta and modern diversification, and finally, we'll wrap up with building your modern portfolio. It's a lot of ground, but we're going to break it all down into totally digestible pieces. Let's get right into it.
Starting off with the optimization toolkit. You see, the real goal of investing isn't just picking the hottest stock of the year. It's really about utilizing a sophisticated, rules-based toolkit to survive and actually thrive during absolute market chaos.
There's this great research from Vanguard that really hits the nail on the head here. They state that a portfolio's asset allocation reflects an investor's goals and temperament, basically the need for return and the ability to withstand the financial market's inevitable turbulence. Because human emotion and portfolio drift, those are the fundamental bugs in our operating system. When the market surges, we get greedy. When it crashes, we completely panic. The three tools we are unpacking today are designed specifically to solve those very human problems.
Moving right along to strategic versus tactical allocation. Let's lay down the baseline of how we allocate our assets, pulling from some excellent insights from Cornerstone portfolio research.
There's a really clear contrast between the two main allocation approaches. Strategic allocation is your bedrock. It gives you long-term, fixed investment guidelines tailored perfectly to your specific risk tolerance and time horizon. Think of it as a heavy anchor keeping your ship steady in a storm. Tactical allocation, on the other hand, well, that's all about short-term agility. It's a highly dynamic approach that actively tweaks your asset mix based on current economic trends to exploit temporary market inefficiencies. So you absolutely need that strategic anchor for long-term survival. But tactical adjustments, those give you the unique opportunities to outperform a standard benchmark.
Now let's see how this builds into our next tool, rebalancing and controlling portfolio drift. This is arguably the most vital discipline we'll cover today.
What's incredibly interesting about Vanguard's data on this is how it visualizes a hidden danger. Over time, as different assets grow at different rates, your portfolio naturally drifts. Because stocks generally outperform bonds over the long haul, a portfolio that is just left entirely alone will slowly drift into higher and higher risk equities. You might start with a super comfortable 60-40 mix, right? But a decade later, you could unknowingly be sitting on an 80-20 mix, exposing yourself to massive volatility just when you least expect it.
And that brings us to a golden rule. The true objective of rebalancing is to manage risk rather than maximize return. I know, human nature makes selling a winning asset to buy a losing one feel totally counterintuitive. It's like trying to write with your non-dominant hand. But mathematically speaking, rebalancing increases your portfolio's Sharpe ratio, which is how we measure risk-adjusted return. By trimming your winners and buying the underperformers, you are locking in those gains and maintaining your intended risk profile. Honestly, it gives you a much smoother ride and helps you sleep way better at night.
To put into perspective why this matters so much, let's look back at the 2008 global financial crisis. An investor who completely ignored rebalancing through the crash was over-allocated to equities right when the bottom fell out and suffering devastating losses. And worse, they were under-allocated during the subsequent recovery because their portfolio was just decimated. Contrast that with an investor who utilized a consistent, rules-based rebalancing trigger. They avoided that fate entirely, which resulted in a staggering 5 percentage point difference in returns over a 10-year period. It absolutely proves that a systematic rule saves us from our own panic.
Okay, 1,107. No way around it, that is a massive number of trades. It's the amount of trades executed over 92 years if you used a monthly rebalancing strategy with a 0% threshold, meaning you tweak your portfolio the very second it drifts. Now compare that to an annual strategy with a 10% threshold. That approach required a mere 14 trades over that exact same century. And care to guess the difference in their tax-adjusted returns? Almost zero. Both remarkably yielded right around an 8.20% annualized return.
So the absolutely crucial point here is this. The exact frequency or the specific threshold of your triggers matters far, far less than the simple act of just having one. Whether you check it quarterly or annually, selecting a reasonable rebalancing approach and ruthlessly sticking to it is infinitely better than doing nothing at all. The secret sauce is just having that disciplined, emotionless strategy firmly in place.
Which brings us to smart beta and modern diversification. We're utilizing some fantastic research from Saxo Bank here to upgrade our toolkit and really graduate beyond basic, plain vanilla index funds.
First, we need to define smart beta. It is essentially the ultimate hybrid. It blends the incredibly low costs of passive index investing with the targeted enhancements of active management. Instead of just blindly buying companies simply because they have the largest market capitalization, which is, what standard index funds do, smart beta uses alternative, rules-based weighting methods to capture very specific market factors.
Now, these specific market traits are called factors. Let's look at the heavy hitters here. Value focuses on undervalued stocks that are poised for a correction upwards. Momentum rides the wave of stocks showing strong recent performance. Low volatility selects investments with reduced price fluctuations for a much smoother ride. Quality highlights companies with rock-solid balance sheets and highly stable earnings. And size often targets small-cap stocks with higher long-term growth potential. By targeting these specific factors, you can literally custom build your portfolio for exactly the kind of stability or growth you personally want.
When we stack traditional indexing and smart beta side by side, the difference is pretty stark. Traditional indexing weights everything based purely on company size. Right now, that means you risk massive overconcentration in just a handful of giant tech stocks. If they stumble, your entire portfolio stumbles. Smart beta completely breaks that mold. By weighting based on fundamentals, equal shares, or those targeted factors we just ran through, it provides a tailored, precise path to your financial goals. And the best part? It does it without you having to pay the massive, wealth-draining fees of fully active management.
Okay, bringing it all together now with building your modern portfolio. Let's take all three tools, strategic allocation, rebalancing, and smart beta, and show you exactly how to apply this optimization toolkit to your own hard-earned money.
Here is your highly practical implementation process. Step 1. Define your objectives. Are you looking for aggressive growth, or are you leaning toward capital preservation? Step 2. Research smart beta funds that actually align with those goals, like a low volatility fund if you just want less stress. Step 3. Diversify across those factors. Don't dump everything into momentum. Blend it with value to really smooth out the ride. And Step 4. Monitor and rebalance using a strict time-based or threshold-based rule. Modern diversification relies entirely on these rule-based systems to keep you honest and disciplined.
And look, the future of this space is evolving incredibly fast. We're soon going to see AI and machine learning dynamically shifting these factor weightings based on real-time, second-by-second market conditions. We're talking about enhanced personalization, where AI balances high dividend value stocks with precise small-cap growth opportunities instantly. Add in deep ESG integration for socially conscious investors, and man, the tools are only going to get sharper from here.
So I want to leave you with a bit of a provocative question to chew on today. Is your portfolio just running on a blind autopilot right now, or have you actually implemented the rules to actively manage its risk? I really challenge you to look at your own brokerage accounts this week. Check your asset allocation, set a firm rebalancing rule, and explore how smart beta could refine your overall strategy. Take the emotion out of it, apply your new optimization toolkit, and take real control of your financial future. Thanks so much for exploring this with me today.